The bulletin is really important. We've had 2 years bleak trading, and now we're arriving at a stage whereby generally people are saying we're near the bottom. It's time to look towards the future, and we'll see how the market sets. And this report, this bulletin, helps us to do that. The bulletin has been commissioned because we've seen some massive changes, the principal one of which is that values have fallen, capital values have fallen by 50%. Of course, the biggest change that we've seen is that the property-owning companies are now effectively the banks. They're our biggest owners of commercial property, and it will be how the banks behave and react to the current market conditions will actually determine the performance for the property market going forward.
The key issues our bulletin covers, first of all, the effect in the short term of the severe economic recession, more particularly the longer term effect of the recession and how strong the upturn will be when it occurs, and what effect that will have on the occupier market, the development market and the investment market. The key findings of our bulletin, first of all, the economic effects. Bank lending will be more restrictive than it has been in the past. Banks will be more conservative in their lending policies. They'll be more tightly regulated. Government spending will be reduced quite considerably because of high levels of government debt, and taxation will have to rise. The net effect of all that will be weaker economic growth than we have experienced over the last 15 years or so. The second key finding in our bulletin was that due to the severe recession, occupier demand will remain weak for some years to come, and that, coupled with an oversupply of floor space, will mean very weak rental growth, probably negative rental growth until 2012, maybe 2013. But then the oversupply of floor space will erode, and then shortages will occur because of the lack of new development, and then rental growth will start to accelerate, and that will be reinforced by the fact that by 2012, 2013, rental values will be well below their long-term trend level in real terms. Our final key finding relates to the investment market. Back in 2005, 2006, 2007, there was a strong investment boom. Yields got pushed down to very low levels. But the credit crunch, when it started, which was then followed by a severe economic recession, has pushed yields higher and higher. They're now something like 400 basis points above where they were a few years ago. And in our view, looking at a long-term analysis, they are now well above their long-term average level, particularly in real terms, which suggests excellent opportunities for longer-term investors. Key lessons from our bulletin are numerous, but I'd just like to concentrate on one or two. First of all, I think economic management must improve. Setting interest rates to target inflation and overall economic output growth is not sufficient. Asset prices must also be examined, and interest rate policy must reflect what's happening to asset prices. And the property market must pay more attention to investment yields outside of property to ensure that the market doesn't get overheated to the extent that it did a few years ago, which has proved disastrous.
The results of the bulletin have given us the opportunity to add to the debate that is ongoing in the industry. There have been some fundamental changes, and those changes will probably be higher yields. But really, it's the contribution to the overall debate that makes this such an important document going forward.